The stock market is open and we see nearly green right across the board. However, the one company that continues to come under fire is Alphabet, which is down around 1.5% today so far. Now, when we take a look at some of the reasons why, well, in fact, the Department of Justice is continually talking about the breakup of this company, and they put this down to it being a monopoly, something that they do not like to see. And this isn't the only company in their history that they have essentially hit with this antitrust litigation. Now, one of the things that they are talking about is how to improve Alphabet in their eyes, and they talk about preventing Alphabet from using products like Chrome, Play, Android to further advantage the Google search. Now, what we really want to highlight out of this process is while there are a lot of discussions about what could happen, whether we actually see a breakup of Alphabet, splitting off to different sectors, whether we have YouTube on one hand and the advertising business, the main takeaway here is that actually nothing has been decided as of yet. And like we have seen with Microsoft in the past, we do believe Google will appeal, and this won't be something that will be rectified in the next few months. In fact, it will take a few years and will be quite long-winded, so we should expect moving forwards this company to continue to be volatile. Now, right now, we do see it down around 1.76%. It is trading in the midpoint of the 52-week range, and we get a double buy rating from Seeking Alpha and Wall Street with a hold from Quant. Now, we believe this is an incredibly strong opportunity to consider adding one of the most highest quality companies in the S&P 500 into your portfolio, and we like it a lot when you do consider on a forward P basis of 21.5. That is lower than the 24 of the S&P 500 and the lowest out of the Magnificent 7 stocks. So let's take a look at this company, understand whether or not it is one you should consider in your portfolio. We can see it does pay a recent dividend yield of 0.49%. It is up 17% over the last 12 months and has significantly outperformed the S&P over the last 10 years, up 518%. Now, when we take a look at this company moving forwards, they are anticipating out of the next 4 quarters, 3 of them not just to be growth on the earnings per share, but to be double digit, which is a very good sign. And we also very much like the fact that over the last 4 quarters, they have outperformed analyst targets. That is a 100% track record. And we do then have faith that they can hit their December 2025 EPS estimate of 8.69, lowering down the forward P to 18.91. Now, if we just take a look at their previous quarter, what we can in fact see is whilst they did beat on the expectations, when you look at the granular information that Wall Street likes to analyze with this company, they did miss on that YouTube ad revenue. So what typically happens, we like to see the earnings per share as well as the revenue, but with certain companies, the market does like a little bit more information. So as we can see and already discussed, they did beat on the EPS. They also did have a marginal beat to the top line revenue, but the main takeaway for the market was that unfortunately they did come under in the YouTube advertising revenue, something that will be looked again when they release their next quarter earnings, which isn't too far away. Their cloud revenue, a nice beat to see, and their traffic acquisition costs, as we can see here. Now, over the last few years, we do like to look at how their revenue has grown, something we will take a look at in much more detail, but we can in fact see from the end of 2022, the growth in their top line revenue has been increasing in the right way that we want to see on a quarter-on-quarter basis. The other thing that we want to touch upon about this company, not something that maybe you do hear too often, but they have made a massive investment into Waymo, the self-driving cars, and as we can see, this was the latest quarter, 50,000 weekly paid public rides, and that is primarily in San Francisco as well as Phoenix. I do believe we have had some more recent information where this number has nearly doubled, and as we can see here, this is something they are looking to go all in, and will be interesting to see how this essentially affects the release of possible information we are anticipating to hear tomorrow when Elon Musk does give us a little bit more in terms of the robo-taxis. As we've already said here though, they have committed around $5 billion in this startup, driverless cars right across America, something that maybe isn't considered when you do talk about this company purely in terms of the Google search. That is what would typically come to the forefront of investors. Now, in terms of this company overall, let's get into the underlying metrics. Dividend safety score 80, that is nice to report, and we have an undervaluation signal which is separate to our own valuation model, but we will like to include today. Now, it was just reaffirmed, but ultimately their dividend does look to be safe. A dividend cut is unlikely. And for those that are interested, in the last recession, they had plus 8% sales. That was well above the S&P. During that time, it was negative 12. Now, this valuation model purely comes down to the forward P perspective against the average over the last few years. And when we zoom in over the last year, pretty much from around August, we can see this company is trading below the expected intrinsic value that we can see from the blue tunnel. Again, we will look at this in terms of actual numbers and a discounted cash flow model shortly too. Whilst on this channel, we do like to look at dividend yield theory, where we talk about how a company is undervalued when the current yield sits above the 5-year average. They haven't been paying a dividend for that long, so this information is irrelevant. But what we really like to see, forward P right now trades around 20. Their 5-year rolling is 23, so that is a good sign of undervaluation. And we can see it isn't too far off the communications sector of 18.2. But as we said, we're not looking at any one of these models in isolation. We will conclude towards the end. Now, free cash flow payout below 60%. For Alphabet, 4% on a trailing 12-month, 12% over the next 12 months. As we can clearly see with this company, we should be expecting some nice growth to their dividend moving forwards. Free cash flow per share looking very attractive, increasing over the longer term. We would like to see more consistent growth. Nonetheless, when we zoom out, looking very attractive, and some very, very strong growth anticipated to the free cash flow over the next 12 months. As we already saw, their sales growth has been increasing over the last few years, but when we zoom out, look over the last 10, we see double digit nearly every single year, 9% in 2023, 13% on a trailing 12-month basis. So again, this is definitely a company that is very consistent in their numbers. Total sales then from a numerical standpoint, 66 billion, so pretty much quadrupled over the last 10 years. And what we do like to see, historically what they've done is they've issued shares diluting your position as a shareholder from 2014 to 2018. Now we can see the opposite, returning of excess cash to your pockets. They've been doing share buybacks over the last few years and quite rapidly over the last few years. If they do continue this, which we do anticipate they will, given what they have been saying over the more recent quarter, this is a nice added bonus alongside what we do deem to be predictable in terms of the increase to the dividend at a very attractive rate. ROIC, our favorite metric on this channel, 10% or more. Give us faith. Management are able to effectively allocate their capital. Significantly better every single year. Last 3 years in the high 20s. Trailing 12-month, 31%. Always a great sign to note, and definitely a filter we would recommend when analyzing companies. Operating margin, we want to see high quality, we want to see operating efficiency over the last 10 years. Whilst we get a little bit of that over the longer term, nonetheless, it is above the 12% minimum, and 31% on a trailing 12-month is a great sign to see. In terms of the free cash flow margin, above 5% every single year, 23% in 2023, 19% on a trailing 12-month. Again, lots of positives with this company. Speaking of positives, the net debt to EBITDA, 0 right across the board. Now, EBITDA, earnings before interest, tax, depreciation, amortization, correlates to balance sheet strength, dividend safety, and shows us, given the numbers below are the number of years it would take the company to pay off all of their debt net of cash on hand, that it wouldn't take Alphabet 1 day to pay off all of that debt, which is a very good sign, and we will show you the balance sheet shortly as well. Now, we also want to point out we have released our latest free weekly article. We deliver one every single Monday morning to your inbox, where we talk about an update in the market, what's gone on, as well as undervalued companies that we do believe deserve your attention. And you can click on the pinned comment below, sign up and read straight away. On top of that, you will get access to 36 undervalued dividend stocks for the month of October, where we have a lot of information for each one and discuss those that sit within our portfolio. And if that wasn't enough, you can also get 22 undervalued dividend stocks, which Wall Street believe have the most upside over the next year. As always, click below, sign up, and you can read straight away. Other parts of analysis on this channel are looking at insider and institutional movement. Insider, well, around 12%. We do notice around 116 million worth of sales over the last year, and we can see in the more recent quarter, Q4, around 4 million. Now, for transparency, we will show you, but remember, we are trying to identify insider buying, as that is ultimately a bullish signal. Insider selling doesn't really tell us much. It could be personal or financial reasons for sale. We do notice then, just last week, the CEO, in fact, selling 22,500 shares at $167, netting him $3.8 million. And doing the same thing for institutions, well, 40% ownership, we have 33.53 billion worth of sales over the last year. We see a lot more buying, so again, institutions do like this company, and we also notice in the more recent quarter, in fact the last 4 quarters, institutions as a whole have been pretty much buying more than they have been selling. Remember though, always do your own due diligence and never copy any of their trades. We also like to look at some bullish and bearish signals from what the market is saying, and we have a few points here in terms of where Alphabet will move. The first signal does talk about how the number of online users and usage will increase, which will in turn therefore help with their digital ad spending, and Alphabet will be the main beneficiary, as right now they do have the largest market share, which has seemed to be impenetrable for quite some time. We can also see here a point on Android and how that will continue to dominate the mobile search moving forwards, as well as the fact, which is something we will come to shortly as well, Alphabet as a whole does generate a lot of cash from their operations, which will in turn be able to help them move forward into other areas, like we already discussed below their $5 billion investment into Waymo and others that they do deem to be profitable. Then when we do look at the flip side in terms of what the bearish news is, firstly we have revenue diversification, which currently does look to be minimal with Alphabet, the majority of that top line coming from search and advertising, but as we said, they are looking at other ways to increase that top line and have a lot less dependent on these particular streams. We also have here some issues around putting a lot of capital towards some higher risk bets where they do believe, in fact, there is a very low probability of generating returns. Now, this is fairly subjective. Some investors will like where Alphabet has been putting their money. Some other investors will like to see that put into better areas. And then the final one we have here is, in fact, whether or not their position is durable. We have already seen a lot of regulation that is coming, the DOJ, and it remains to be seen whether or not anything will really happen from this. As we've already said, they have tried this with Microsoft and weren't successful. Now, we did look at the revenue earlier, but again, we just want to highlight here the bottom line net income. So a quick recap of the revenue itself, increasing over longer term, in fact, around 4 times growth, which is great, but can we see that same effect on their bottom line net income? And we do notice growth as well from a graphical basis, a little bit inconsistent over the last few years. Nonetheless, it has shot up from 14 billion in 2014 to 74 in 2023. We also note on a trailing 12-month basis, it does look like it is moving in that right direction at around 88 billion. Now, we've already said their balance sheet is very strong, so let's highlight it here for a quick health check. Total cash versus total debt. It has increased from 2014, as we can see from this graphical basis. 62 billion in 2014, 100 billion just in that latest quarterly report, which puts things into perspective. They put around 5 billion into Waymo. That accounts for around 5% of their total cash position just right now. But now let's look at what we are here to do, which is their total debt comparison. And we notice 100 billion of cash. Right now, their total debt at around 28.7 billion. So no surprises. They could pay off all of that debt in one day if they really wanted to. Now, a few pointers before we do jump into the actual valuation model. When we look at some of these gradings and underlying metrics on a PE basis of 21.5, the sector median is lower at 13.48. So you are ultimately paying a premium for Alphabet at 59.48%. Whether or not you believe that this company does deserve the premium isn't necessarily the question, because I think we have highlighted that already today. The question is, what kind of premium is this company worth? As we can see, whichever metric you use in comparison to the sector, you are paying quite a hefty one. In terms of their growth grade, well, they get a B-. Revenue year on year looking good, 13% versus the sector of 2%. Moving forwards, also looking attractive, 11% versus the sector median of 3.1. And when we do look at the EPS over the next 3 to 5 years, 16.7% is a lot better than the sector median of 10.4. So does look good in terms of growth in comparison. And the final one is that profitability grade, where it does get an A+, margins looking really good, 58% versus 51%. Bottom line looking absolutely fantastic, 27% versus 3.09%. And this is what we were highlighting earlier. Their cash from operations over the last 12 months, 105 billion, significantly higher than the 289 billion of the sector. So a quick recap for Alphabet: a double buy rating from Seeking Alpha and Wall Street, a hold from Quant, D- on valuation, B- on growth, with an A+ on profitability. Now, how do they compare against these others in the sector? Well, we have names that you must have heard of: Meta Platforms, Tencent Holding, Baidu, as well as some others. And what we in fact noticed over the last 12 months, Alphabet has been pretty much in the middle, up 17%, when we look over the last 5 years, what we in fact see, it is one of the better performers, right up there with Meta, up 169%. And over the last 10 years, it is again very similar with Meta, up 520. So very, very strong performances. Question is, do we believe this can continue over the next 10 years and beyond, as the past performance ultimately doesn't determine the future? The other point that we do want to focus on here is whether or not we believe it can beat the S&P 500 moving forwards. Over the last 12 months, it has underperformed 19% versus 33%. Over the last 5 years, though, we do see the opposite, as well as over the last 10 years. So it will ultimately come down to whether or not you have that faith, because there are considerations for just investing in an S&P 500 ETF like VO, which is low cost and could give you some exposure to Alphabet, but not exactly 100% if you don't believe it can outperform moving forwards. Now let's jump into the valuation model. As always, if you do enjoy the content, value is being provided, smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. So $188, we've come through this from the DCF model, where we have the free cash flow year on year, average growth rate at 24%, and today's episode we have gone lower at 10%, which is ultimately lower than both the average as well as the more recent increase in 2023. As we can see though, for transparency, we have a low, medium and high rate. At the 10% with the discount rate, we get the present value of future free cash flows and terminal value, add together with the cash, subtract total debt, get to the equity value, divide by the shares outstanding, and as we can see here, undervaluation, which ultimately gives 17%. And we do believe in today's episode we are being more on the cautious / conservative side. Now remember, these numbers are subjective, so you can grab a copy of this model by clicking on the pinned comment below, running through your own numbers, whether it's for Alphabet or any others. But to continue, let's just show you at the 15% rate, if this is what you deem to be more appropriate. Intrinsic value of $265, indicating 65% upside. At 20%, as we can in fact see, 372, which would deem you can see this company more than double the current trading price. Remember, that is in fact lower than the average, so you could argue that isn't essentially unrealistic. So at the 10% rate, just to take it through to the next slide, we always like to add a margin of safety on the channel. 10%, which we execute on if it meets our 3 golden criteria: wide moat, strong financial metrics, good forward-looking data. If you believe that in today's episode, well, Alphabet is a buy up to $169, then we keep going till it's near the current trading price, and we see this have around 15% MOS at the 160 mark, which we do believe to be attractive given we have used cautious metrics, and we do believe this to be a very high quality company with a very strong future. Now for those that want to see it higher, well, at the 20% mark, a buy at 150, at 25% around 141, but as we said, around the 15% MOS today, with Wall Street very bullish, their price target $202, they see 25% upside over the next 12 months, but do remember they do still have that DOJ probe hanging over them. Whether or not we will see the breakup is a question that could produce a lot of volatility in their share price over the short to medium term. As always, if you enjoyed today's episode, smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. Don't forget to sign up to the free weekly newsletter by clicking on the pinned comment below, and you can also come and join us in the Patreon where we are talking about our weekly buys and sells. As always, have a great day and we'll see you all on the next one.